Good afternoon, everyone, and thank you for joining us. Welcome to First Franchise Capital's webinar, Using Debt to Grow Your Business, a Lender's Insight, presented by folks here at First Franchise Capital. We'll be getting started soon, but first I'd like to mention a couple details before we get started. As a courtesy to the other webinar attendees, your phone line has been muted, but we welcome encouraged questions throughout the webinar. If you have something you'd like to ask during today's webinar, please use the chat interface function located at the top of your screen. We're going to keep this webinar to 30 minutes, so if we receive more questions than the time allows, we'll respond to any additional questions after the webinar. My name is Lindsay Raridan, and I will be your moderator today. I joined First Franchise Capital in 2016 and specialize in marketing to multi-unit franchise operators. I graduated from the University of Tennessee and have been in the financial services industry for 4 years. With me today I have Bill Nicholson, Pete Austin, and Adam Pleva here to answer your questions. If you each want to introduce yourselves, Bill, we'll start with you.
Sure. Hi, my name is Bill Nicholson. I'm the Executive Director of Sales for First Commercial Finance, which encompasses both First Franchise Capital and our sister company, Oak Street Funding. I've been a part of the combined management team since September of 2009. I spent the better part of the last 20 years within the financial services industry, gaining a broad level of experience across both consumer and commercial lending.
Perfect. Pete?
Hi, my name is Pete Austin, and I'm a Regional Vice President here at First Franchise Capital. I'm based in Pittsburgh, and I've worked in the franchise lending segment for the past 18 years, including the last 5.5 here at First Franchise, where I cover a territory that includes the states in the Mid-Atlantic and Midwest.
Thank you. Adam?
Yes, my name is Adam Pleva. I've been with First Franchise and Oak Street Funding since 2008. I am currently a Vice President of Sales here at First Franchise Capital, and I primarily focus on helping restaurant franchisees with their financing needs and ultimately trying to achieve their business goals.
Perfect. Thank you all. All right, let's go ahead and dive into the questions. Thank you to everyone who submitted a question beforehand. We've included all that we could within this presentation, in addition to answering some of our most frequently asked questions. So let's go ahead and get started with question 1. What are the biggest hurdles restaurant franchise businesses face while striving to grow? Pete, let's have you start.
Thanks, Lindsay. There's really 2 ways you can grow, by acquiring stores and by building stores. And I think we're going to talk a little bit about acquisitions later. I know there were some other questions on that. So I'm going to touch on a couple key obstacles now on when it comes to building new stores that we see firsthand with our customers and prospects. I'd say first and foremost, you can't build new stores if you don't have the development rates from the franchisor. We often see franchisees who are landlocked either because another franchisee has the development rights surrounding their existing stores, or their territory is already saturated and opening additional stores would only cannibalize existing sales. In that case, you can look at expanding into a different geographic territory, which brings a whole new set of operational challenges, or branching out into a secondary concept, which generally has to be in a different segment to avoid the wrath of your current franchisor. The next key area that we see is finding the desirable real estate to rent or buy at really a reasonable cost. There's a lot of competition among brands for the best locations with ideal demographics and traffic counts. And, you know, we see a lot of franchisees struggle to find the right property at the right cost where they can make the unit level economics work for a transaction. But, and next part of it I'm going to touch on is infrastructure. Do you have the infrastructure in place right now to support additional store growth? And this includes the back office capacity. Do your area or district managers have capacity to take on new stores? And hourly and managerial staffing for the new store. In the current tight labor market, can you attract the right people at a reasonable cost to make the unit level economics work? And finally, unless you have a lot of excess cash sitting in the bank, you need access to capital to help fund the development of new stores. Do you have satisfactory credit metrics on your existing store base? Is your current debt load reasonable relative to the amount of cash flow your stores generate? Do the projected unit level economics for a new store support the amount of debt you're looking to borrow? And do you have a relationship with a lending partner that understands your industry and concept and is willing to support your growth plans?
Excellent, thank you. Moving on to question number 2. What are some of the biggest mistakes people make when trying to borrow? Bill?
Sure, thanks, Lindsay. I would say the overarching number one thing that we see across really all of lending, whether it be consumer or commercial lending, is just the general aspect of being unprepared. When engaging in the initial conversations with a lender, they are going to want to have a good sense that you have a very good grasp of your current business operations, along with any additional locations that you may be looking to acquire or potentially develop. That includes some kind of very basic things, having a clear business plan, having done due diligence on, again, if you're in the situation of potentially acquiring stores, really understanding what it is that you are purchasing. Having a very succinct organizational structure and ownership summary, having historical financial statements and tax returns very handy, maybe going ahead and preemptively getting management bios together, reviewing and understanding leases and franchise agreements, prepping an internal team. So what we often see is that in these very complex type of transactions, that it really takes a team of individuals working for that applicant to get to the finish line, and that could include having your CPA involved, having an attorney involved, especially if there's real estate that's involved in the transaction, but probably most importantly, having that designated contact person for the lender to have that open line of communications with, because you as the principal or the owner may not always be available, on a short notice. So really having that designated person that can field those calls, that can have that constant open line of communication with the lender is really paramount. And I would say certainly understanding the strengths and the deficiencies of the existing management team, and really taking a good look inside and saying, okay, where could we potentially improve? Where could we potentially have obstacles in the future? And ensuring that you're putting together a management team that really plays off of those strengths and any deficiencies that you have, ensuring that you put the right management team together that certainly complement that as well.
Perfect, well said. Question number 3, when acquiring other stores, what are some things to pay attention to? Adam?
Well, that's a great question, and I've, obviously talking to clients about this every day, I really just tried to sit down and put some thought into this a little bit more, and I really want to try and group this into 3 areas for everybody taking notes. First one is financials. Second one would be operations, and the third would be geographic impact. So let's talk about the financials. I think foremost, you have to look at net profits and same-store sales trends. Can they support your needs, your priorities, your debt service? Coupled along with that, I think historical cash flow, what the historical EBITDA is, especially if you are new to the concept, you want to pay close attention to that. And if you operate existing stores in the concept, making sure that you have a pro forma form for yourself based upon variable expense margins of your existing stores and actual rent expense. So the next group would be operations. What's the condition of the equipment? Are all the items within the location well maintained? What are the condition of the facilities? What was the date of the last remodel? What's the next remodel requirement date and estimated cost? And really you need to understand if and when that expense will come into play and the affordability of that debt service to accommodate it. Also have to consider lease terms, I believe. What is the remaining term on that lease? What are the renewal options? Are there going to be bumps in the rent or percentage changes in the rents? So all those are things to look at when it comes to the operations. And then third, with the geographic impact, I think the geographic relevance as far as that's concerned, we all know earnings may vary with geography. And your FDD for each concept should state whether there are geographic differences between the franchisees whose earnings are reported in your likely location. Are you buying a location in a protected area that could affect other future development, and what's the competition in the area. So, does the franchisor or other franchisees have the right to develop new stores in close proximity to your store, which could negatively impact sales at your location? So that's something really to think about. And I think last, always check with your town or your city's DOT just to see if there's any future construction projects that could affect the traffic to the location that you're going to acquire post-acquisition.
Thanks, Adam. We'll move on to question number 4. What are the key components in determining loan requirements and structure? Pete?
Thanks, Lindsay. So as a lender, once we get comfortable with the borrower and the concept they're operating in and the credit strength of the transaction, we look at a number of different components to determine how to structure the loan. I'll touch on 4 of those now: collateral, ownership structure, use of proceeds, and pricing are the 4 key areas I'm going to touch on now, and I'll start with collateral. Does the borrower own the underlying real estate at the store, or stores being pledged, or are the premises leased from an unrelated third party? That's the most important thing for us initially in determining how we structure the loan. If the borrower owns the real estate, we can file a mortgage on the land and the building. And real estate, as we know, generally appreciates in value over time and has value in the event of a liquidation scenario. Thus, we can generally offer a higher advance rate on real estate and a longer amortization or payback term. But if the real estate is not owned by the borrower, as a lender, we can really only file a UCC lien on the equipment, which may have limited value in a liquidation. And as a result, our advance rate is lower, and we've structured a loan to get paid back faster on a shorter amortization. The next component I'll touch on is ownership structure of the business. Are the stores owned in separate LLCs or a single entity? Which individuals have ownership interests in these entities? This drives which entities we require to be borrowers, co-borrowers, guarantors, and also which owners we require to personally guarantee the transaction. Next area would be what's the use of the proceeds? Is it a development loan for real estate or lease sites? If it is, we'll structure the deal with loan advances during a development period that are interest only, and once the project's completed, the balance is termed out into an amortizing loan with regular monthly principal and interest payments. If someone's doing multiple remodel projects, we might structure the deal as a non-revolving line of credit that's interest only for a period and then terms out quarterly or semi-annually or some frequent time. Term loans are fully advanced at closing for refinancing and acquisition, so those are a little bit simpler structure. The final point I'll touch on is how do we determine pricing for a transaction, and this is driven by a number of factors, including what's the restaurant concept, how many units are there in the system, and what's the overall recent performance trends in that brand, what are the credit metrics for the financing request, how experienced is the operator, and those are the sort of key factors that we'll put into our models to determine what interest rate we can offer on a transaction.
Thanks, Pete. So we talked a little bit here about how do we determine loan requirements and structure. So now let's kind of like take the reverse side and what are common reasons someone would not get approved for a loan? And Bill, you want to take that?
I sure will. First and foremost, I would say do your homework. Be very strategic where you apply, because working with a lender that's unfamiliar with providing financing within the franchise restaurant industry can really cause an applicant to waste a lot of time and resources. Some of the more obvious, poor historical performance or lack of operational experience, declining sales trends as a whole or at the borrower's specific locations, ensuring financial ratios are aligned to the lender minimums or maximums. Make sure that there's been an open dialogue with the franchisor, that there has that you've reviewed the franchise disclosure documents, that the franchisor has obviously approved that individual to move forward. Insufficient startup costs, again, a lot of expenses that especially new individuals getting into the franchise industry may not necessarily be aware of. Having overly aggressive growth plans in order to just make the math work, in order to show that there's enough income that's being generated to not only cover current expenses, but also cover the additional debt service that the borrower would have after having secured a loan. Over leverage, obviously having too much debt relative to the amount of cash flow the business is generating, and the inability to demonstrate that the applicant can handle the size of the operations that they are looking to acquire. If that's applicable, one good scenario is a principal having ownership of, let's say, 4 or 5 locations, then coming to a lender and trying to increase the amount of locations that they have in that within the umbrella of locations from like 5 to 50. It's a huge step, and it can be very difficult for a lender to get comfortable because size of operations are drastically going to increase. The number of headaches that could come up kind of along the way, again, just gets multiplied by each location that's added into the operational network of the owner.
Thank you, Bill. We'll just go ahead and keep moving on. Question number 6, how does First Franchise Capital decide how much I can borrow? Pete?
Yep, thanks, Lindsay. So what's the advance rate is often one of the first questions we get from borrowers. And as we talked about before with the collateral question, advance rate really depends on the type of collateral being pledged for the loan. And I'll start with lease locations, in which the borrower is only pledging the equipment or FF&E to the lender. Our source of repayment is the cash flow from the collateral stores. So we calculate the EBITDA for the transaction, which is essentially your net income, plus we add back interest and income taxes and any non-cash items. And for our analysis, we look at EBITDA after subtracting all your above-store G&A expenses, so your area managers and office expense and whatnot. We look at on a net of that G&A basis. And so from there, we'll size the maximum advance rate based on 2 key ratios, which are the maximum debt to EBITDA and the minimum fixed charge coverage ratio, or FCCR. So debt to EBITDA is a fairly simple calculation of debt, the amount of debt that you're borrowing divided by the EBITDA. And fixed charge coverage ratio is calculated by adding your rent expense to your EBITDA to come up with EBITDAR. So EBITDA plus the rents, which is the numerator for that ratio. The denominator is the sum of your annual rent expense plus the annual principal and interest payments on the debt or the proposed debt. So we want a borrower to have excess cash flow, an excess cash flow cushion to cover those fixed charges, the rent and principal and interest payments in the event of a sales or margin downturn or decline. So we also look at a third ratio, which is the loan amount divided by the average replacement cost for the collateral stores. And this is determined for a store by looking at the new build cost estimates in the Concept FDD and various industry reports that we get. And our loan amount's ultimately limited to a multiple of what that average replacement cost is. So it's cash flow based, but it's also it's cash flow derived, but also limited by the replacement cost. If we're providing financing secured by real estate that the borrower owns, we determine the maximum advance rate as a percentage of the third-party appraised value of the real estate, with a caveat that the cash flow generated from the store also has to be sufficient to service that amount of debt. So it's not just a hard asset loan; it's a cash flow loan as well. The store cash flow has to support that level of debt that we're putting on the store. And if the store hasn't been built yet, the appraiser will do an as-built appraisal based on the plans and specs for the new store. And the last thing I'll touch on is the advance rate for acquisitions. We've analyzed the advance rate for acquisitions in the same manner as I reviewed for equipment secured and real estate secured loans, but we generally require at least 10% equity contribution from the borrower. And the final equity contribution amount ultimately depends on the purchase price multiple of cash flow that you're paying. So if you're paying a real high multiple, it's going to require a greater equity contribution. But if you're also pledging existing stores as collateral, we can look at using the embedded equity in those stores if they're under leveraged as a contribution towards your equity requirement for an acquisition.
Thank you, Pete. We have one last question before we take a couple questions that came in through the chat box throughout the webinar. So our last question is, why First Franchise Capital? What makes First Franchise Capital different than other lenders? Adam?
Great question, Lindsay. So, I get asked this question all the time, but, first and foremost, I think it's just because we're specialized. Being a specialized lender, to the multi-unit franchise restaurant operators, we have a great understanding. We really practice internally relationship lending. I mean, we want to build a lasting relationship. We just don't want to have a one-and-done type of client. I mean, sometimes that's the case, but it's really our goal to continue to work with our clients to help them grow and help them build upon their objectives. I truly believe that, this is a transitional experience for our clients rather than a transactional, which can, be experienced with a lot of other banks out there. But with a transitional experience, it makes you feel like you're important. So the customized solutions that we provide, obviously trying to tailor everything to, specifications of the borrower. We try our best. Obviously, it's not always, happens like that, but, it is our goal to make sure that we have happy clients and we're giving the right service to them. We are a full-service lender, and we, provide funding for equipment, refinances, new store development, partner buyouts, remodels, real estate, and acquisitions, like we talked about earlier. And that kind of leads me into, some of the resources that we provide with Franchise Exchange. Now, with Franchise Exchange, we try to bring buyers and sellers together, and that's part of our website. We don't really act as a broker. We kind of use this as a tool that hopefully we can earn the funding from that relationship that was gained there, and hopefully it works out for the buyers and sellers that are that check that site out and put their information up. But overall, we are a portfolio lender with a focus on your growth as a client. We have lending limits up to $30 million, and our goal is to understand what priorities you have as it pertains to any objectives, improvements, or enhancements for your operations. Now, at the same time, it's very important for us to identify any requirements that you may have of us as a lender so that we can know what is required to have a successful transaction and relationship with you.
Thanks, Adam. Mm-hmm. We had a couple questions come through during the webinar. The first one is, how will the rising interest rates affect me and my business? Bill, do I take that one?
Sure. This is kind of the elephant in the room because with the volatility that we see almost on a daily basis in the markets, it's really top of mind for anyone looking to borrow in today's rising rate environment. Higher cost of funds is directly going to equate to increased interest expense, which is going to drive lower profitability overall. Increased cost of borrowing ultimately leads to lower acquisition multiples. So reduced prices for acquisitions could keep a seller from selling, could impact the M&A market. Having multiple pro formas, really having a good understanding of how different expense structures will impact the long-term viability of the business is always a good thing to have on hand. Understanding sale leaseback options, locking in long-term financing at more favorable rates. And I guess one positive would be in the instance if you've got a lot of cash on the balance sheet, you could see a benefit because cash has the ability to earn more income in a rising rate environment. But typically it's going to direct the bottom line. It's going to cost more to borrow money, which overall is going to have to be absorbed within the business model that the owners put together.
Thank you, Bill. Looks like we have time for one last question. So let's do this one. What are some trends you see as a lender in the restaurant franchise industry? Pete?
Thanks, Lindsay. The first trend I would say is consolidation. And I was just reading the Restaurant Finance Monitor this month, and they were talking about how there's now 4 restaurant franchisees that generate sales in excess of $1 billion a year, and there's 130 with revenues greater than $100 million a year. But it's not just the behemoths, I think, that they're doing all the acquisitions. We're seeing across the full spectrum of operator size. A lot of smaller franchisees don't have the economies of scale and access to capital to compete with the larger players. And to remain relevant, we're seeing a lot of franchisors that are requiring significant remodels A lot of franchisees don't want to reinvest that amount of money in the business and ultimately choose to sell. And sometimes, frankly, they get offers that they can't refuse based on where some of the purchase price multiples we're seeing out there are, and they're not even necessarily looking to sell, but the offer comes in and it's something they couldn't pass up. So, and lastly, we're seeing a lot of aging operators who are looking to retire and don't necessarily have a family member they want to pass the business on to, so they end up selling to another franchisee. To touch on one other trend I've seen out there a fair amount is concept diversification, and I think I mentioned this a little in my first question. We're seeing a lot of experienced multi-unit operators in one concept that decide to develop stores in another brand, and they may not be satisfied with the growth opportunities in their existing brand, or they may see more attractive unit level economics and sales to investment ratios in another concept. So we see a lot of operators branching out in other brands, and oftentimes it's a newer up-and-coming concept in a different segment than where they currently operate in. So,
thank you, Pete. Looks like we're about out of time for the day, but we'd like to thank each of you for contributing questions and attending our webinar today. If you have any additional questions, please don't hesitate to contact us. Our speakers, Bill, Pete, and Adam, are up on the screen, their emails and phone numbers. And we will send out all of this information, both the presentation and a copy of today's webinar recording, in an email to you so you have it for your future use. Thank you all and have a great day.